Hello everyone, welcome back to CFA with Jay. And today we'll be starting with what is derivatives and different kind of derivatives, and we'll cover a few things throughout the video. So we'll be beginning with forward contracts. So before we begin, we should understand what derivative is. So derivative is technically a contract which derives its value from the underlying asset. For example, you have a asset called as soybean, and you are creating a contract stating I will buy this soybean, I mean a specific quantity of soybean for this much price at this much date, uh, on all the specific things, and this entire contract is called as a derivative. Now, there are different kinds of derivatives, for example, forward futures, swaps, and options. Options are options, we'll learn about it, but yes, these are few kinds of derivatives we'll be learning in this series, we can say. Okay, so let's begin with forward contract. So what is a forward contract? It is a type of derivative contract where there are two parties, a buyer and a seller. They come into an agreement to buy and sell a specific product at a specific rate and on a specific maturity. So in a forward contract, there is always a long party and a short party, the one who buys the contract and the one who sells the contract. Now in this scenario, let's take an example. Suppose A agrees to buy 100 shares at 50 rupees each on a future date. Let's assume T1. Okay. So at T1, what will happen is now A has agreed to buy. So B will have to sell 100 shares at the rate 50 rupees to A. So here B becomes our short party and A becomes our long party because A is buying the contract and B is selling the contract. Now there is a situation where it might happen that the spot price or the current price of these shares is rupees 25. So in this situation, usually now if the spot price of the share is 25, so there is a difference, correct? Even if the spot price is 25, A has to buy those 100 shares in 50 rupees only. So instead of exchanging 100 shares for 50 rupees and then giving back 25 and all of that happening, what we do is A will only give back the 25 into 100 rupees to him because he's already getting the shares of 2500 shares of 25, correct? So the remaining amount is how much? 50 minus 25, that is 25. So 25 if into 100, that is 2500. So A will only give 2500 to B, and in return of 2500 he will receive 100 shares for 50 rupees each. So this is something called as cash settlement, and this usually happens in forward contract. Now, forward contract is traded on an OTC platform. It is a not standardized platform like how NSE and BSE is. It is not at all standardized. We'll actually learn about it in one of the future videos about the OTC platform itself. So just remember that forward contract are traded on OTC platform. So forward contracts are customizable and it can be customized according to the needs of the buyer and seller of that contract. Now, in this situation, the short party, like A is buying the contract from B, right? So B is called as counterparty. And there is something called as counterparty risk. Now, what is counterparty risk? Let's understand this from a point of view of A, correct? So from point of view of A, B will give him counterparty risk. Now, what is counterparty risk? It is technically the risk that B will not be able to give A these 100 shares at 50 rupees at time 1. He will default. And this is what counterparty risk means. Now, from point of view of B, like what will be his counterparty risk? So his counterparty risk is that A will not be able to pay him the amount that is being mentioned in the contract. This is the risk B is taking, correct? So this is called as counterparty risk. The risk of another party that is involved, another from us that is involved in the contract, that is called as counterparty risk. As simple as that. So a derivative has two types. One is firm commitment and the other is contingent claim. So in firm commitment, what happens is that the both parties, like what we discussed in forward contracts, both parties, let's take an example, A and B, predetermine the rate at which a commodity or the underlying asset is being sold at what time, at what rate, and etc. Everything is predetermined. So examples of firm commitment are forward, futures, and swaps. What is contingent claim? Contingent claim is when only one of the party, like either A or B, will decide at what rate and at what time the underlying asset will be sold or purchased. One example, so the example of this contingent claim is option. We learn about options more in further videos, but just remember that one contingent claim, example of contingent claim is options. And firm commitment examples are futures, forwards, and swaps. So next topic is derivative markets. So there are different kind of derivative markets. So first one is OTC. OTC means over the counter market. It is where two parties come together and form a contract, as simple as that. But OTC is not centralized or it is not standardized. It is not looked over by any of the government or anything. Like SEBI looks over all the NECs and BSEs. This OTC platforms are not standardized. It is a bit riskier. So because there is no strict rules in this OTC platform, we can say. Now, there are three parties involved in OTC. First one is derivative end user. What is derivative? Who is a derivative end user? The one who uses the derivative contract or the underlying asset in that contract for his own personal purpose or for his business, but he is the end user of that uh, underlying asset of the contract. He doesn't sell it forward or anything. He is the end user. That is what a derivative end user means. Now, second one is dealer. Now, dealer is a counterparty to derivative end user. As we learned before, counterparty is another party in the contract who buys or sells the contract. Third one is market maker. Now, market maker is a type of dealer who constantly quotes his bid and ask price, or who constantly quotes the price at which the contracts will be bought or sold in the market. Now, how it works, it is very simple over the OTC platform. A derivative end user approaches a dealer to make a contract. They customize the contract on their own or on their uh, conditions, specific conditions, and the contract takes place. That's it. Next is exchange traded derivatives. Now, there are few of the derivatives that are usually traded on exchange. This platform is standardized. For example, NSE. Uh, like futures are traded on NSE, like that. The exchange traded derivatives are the derivatives that are traded on a particular exchange, like NSE. Now, the terms and conditions of these contracts or these derivatives are usually set by the exchange itself. These dealers quote their bid and ask price, and we, the end users, buy or sell those according to our needs. So this is how it is not customized. It is so the only difference between the OTC platform form and exchange traded derivatives is that it is standardized. A exchange, a particular party is stating the bid and ask price of that contract, and you have to go along with it as a derivative end user. Now, there are situations where, for example, a dealer has quoted a price which is not that good or not that attractive to many derivative end users. So there are rarely very rare people who are going to buy that or sell that. So there are somebody called as speculators or risk takers who buy these kind of derivatives and they take all the exposure, all the risk on themselves. Now, on these exchange traded derivatives, there is actually also a certain amount that is taken as a collateral during the inception of the order, during the life of the contract to safeguard both the parties, we can say. This is also another different thing that OTC does not do. This is how exchange traded derivatives work. So the third type of market is central clearing. So what happened in 2008 during the financial crisis that happened in 2008, there was a mandate that was passed by the government stating that all the derivatives need to go through central clearing. Now, what does go through central clearing mean? Uh, Now there were A and B correct in a contract, but now there will also be a C in between the A and B. Now this C is the central clearing house, we can say. Uh, so instead of A being exposed to B's risk and B being exposed to A's risk, there will be a middleman in the between who will counter this risk. Now, CCP guarantees this trade, hence, it reduces the risk a little bit. So, it is much safer than OTC platform or exchange traded derivatives. The central clearing is much safer. So, how does it safeguard you from the risk or reduce the risk, we can say, not safeguard, but reduce the risk. So even the central clearing house takes certain kind of deposit, initial deposit from both buyer and seller of the derivative contract, and it is with them. So this reduces the risk exposure to a very certain content, we can say. And then there is also a variation margin that is being maintained throughout the contract's life. In central clearing, there is also daily settlement that is being maintained. It is called as mark to market. To understand mark to market, let's take an example. So suppose let's start from 1000 rupees. Let's take a basic amount. So suppose A and B both have given an initial margin of 1000 rupees. So next day what happens? The suppose it was 100 shares for 10 rupees. And then they have deposited 1000 as the initial margin, we can say. So what happens next day? The price of the spot price of those shares of that specific company rises to 11 rupees. So now what A who has bought this contract will gain 1 rupee, correct? Sorry, 100 rupees, correct? So in his account, it will show as 1100. And in B's account, it will show minus 100, that is 900 rupees. So this is how it maintains the balance between the givers and the receivers. So the risk exposure is very low, the transparency is more, and hence people sometimes prefer this as a more safer way of investing. So novation is a process that this name you have to remember. Suppose there are two companies, for example, Infosys and JP Morgan will take. So if Infosys and JP Morgan are coming into a trade contract, what happens is CCP novates this contract, and now JP Morgan has to answer CCP, and who was the other one? Infosys has to novate to the CCP. There is no direct contact now. The middle party is going to be there, that is CCP. So that's it for this video. Just revise all of these things that are mentioned. It is most of the very important and basic things. So revise this. In next video, we learn about future contracts and swaps. And after that, 2, 3 videos are lined up as usual. So stay tuned for next videos, revise this, and